Now, if you read the press, you would think China is actually doing amazingly well. The future looks really bright. It's due to overtake the US economy by the end of the decade. And everything is looking amazingly rosy. But today, I'm going to give you 10 reasons why I think things are not so great for China. And my first one is this: debt has been increasing across the board. So government debt, individual debt, and corporation debt has massively increased over the last 10 years. So if we take as one example total government debt to GDP, in China in 2012 it was 34%, but by 2021 this had doubled to 68%. Now, I'm not saying 68% is particularly high. Indeed, it's a lot lower than almost all Western countries, but it's going in the wrong direction. And as I said, coupled with increasing corporation debt and increasing individual debt, this is going to be a problem for China in the future. But number two, my point on low birth rate and demographic issues is actually even more serious. So unlike countries in Asia like Cambodia, the Philippines, Indonesia, and Vietnam, the birth rate is well below 2 per couple in China. It is around the 1.65 mark. But what is much more worrying is that China has an aging population, which is indeed aging much faster than most Western countries like the UK, France, and Germany. The UN actually predicts that by 2060, there will be more people over the age of 65 than those of working age 16 to 64. And it is also expected that the population of China will start to decline around the year 2030. So you can see there are some really serious demographic issues with China, and all is not well. Number three, increasing labor costs. So with increasing labor costs, foreign companies are starting to look elsewhere in countries like Vietnam and Cambodia, where labor costs are much cheaper. And I think this is bound to have a detrimental effect on the Chinese economy. Point number four, I want to talk about the restrictive market for foreign investors. So China makes it very difficult to invest in its country. So you cannot own freehold property in China. All of the land actually belongs to the state. And you can only buy property on a maximum of a 70-year lease. So you never really own the property. Furthermore, you are only allowed to buy one unit, and you are not allowed to be a landlord and hence rent out the property. Before you're allowed to even buy, you will have to work either 1 year or study 1 year in the country. Buying stocks is also not straightforward. So buying in stocks in China also comes with restrictions. You can only buy the top rated stocks via Hong Kong. China as well also makes it difficult to get a business visa. Number five, I want to talk about the worsening relations with the US. So there are strained relations with the US, which may lead to a trade war, which could really hit China very hard indeed. Number six, I want to talk about the declining GDP growth in China. So the days of double-digit or near double-digit growth in China are over. From 2010 to 2019, GDP growth went steadily down from 10.8% in 2010 to 5.95% in 2019. Now, 5.95% is still fantastic growth, but it's going the wrong way. And even after the pandemic, it is predicted that the GDP growth in China will start to steadily decline. So again, this is not a good sign for China. Number seven, there are better options in Asia. So countries like Cambodia and the Philippines, as said, have higher birth rates, are growing faster than China, and foreigners can also own freehold property. Number eight, I want to talk about China being a mature market. Now, I'm amazed to read sometimes that many people still talk of China as an emerging market, but in reality, all the best investment opportunities really have come and gone. In particular, when we look at the real estate market. And point nine, and I think potentially this is the most important point in this video, is China's dependency on the real estate market. Now, listen to this. It is estimated that the real estate sector accounts for around 30%, yes, 30% of GDP in China. So should the property market collapse, this could have untold damage to the Chinese economy, and the signs are not good. Now, for those of you who follow financial affairs, you'll not have failed to have noticed that the Chinese real estate company Evergrande has been of late regularly on the news, and for good reason, because it is very heavily indebted company, because it's borrowed on the assumption that property prices will continue to rise in China for the foreseeable future. But I just want to tell you this. Let's look at cities in China and look at how expensive they are compared to people's incomes. So going by Numbeo, which is quite a reliable source for looking at property prices, in Shanghai we are talking about a ratio of 33. In Beijing and Shenzhen, it's actually even worse at over 40. And even in other major cities like Nanjing, Hangzhou, and Guangzhou, the ratio in each case is above 25. So it's looking well and truly as if property is very unaffordable for the locals. And let's make a comparison. Moscow and Paris in Europe, which are considered incredibly expensive to buy for the locals, here we're looking at the 20 mark. So we are starting to get a picture of how serious the problem is. And I think the website, I've looked at other websites as well. Now, Numbeo, I think, actually comes at the lower end of predictions. On other websites, price to income ratios are even higher for these cities. And what I want to add as well is that there's been a lot of building in China in other parts where the demand is not very high. So we've got a lot of empty apartments in China. This is not great for the property market. And listen to this as well. Another bad sign of a property market is when you've got low and falling yields. And this is exactly what's been happening in Shanghai and Beijing, where you'll be lucky to get gross yields of 3%. Think back several years ago, in these two cities, you could get gross yields of 7 to 9%. But as of now, we're looking at a maximum, if you're lucky, of 3%. This is a bad sign also for the property market. And look at what the savvy Chinese investors are doing. Many of these Chinese investors are looking elsewhere. They are voting with their feet and investing in property abroad, like, for example, in Asian countries like Cambodia, Philippines, Malaysia, and they're also heavily investing in North America and in other countries in Europe, such as the UK, Italy, Spain. So a lot of the more clued up investors in China are looking for property abroad. Another bad sign for the real estate market. And number 10, I actually want to make paragons with Japan. Now, 30 odd years ago, Japan was in a similar situation, and the problem started with a real estate bubble. And then we know what happened. Real estate went down and there was a heavy stock market crash. So if you'd invested in Japan in 1989, you still would not be seeing a positive return as of today. So this might well happen in China as well. I actually think it will happen. So things are not really that bright in China. And if you are to invest in China, whether more likely in the stock market, or if you do get a chance to buy property, you really need to limit your exposure, because I think things are not as great as they seem in China. Anyway, I'd love to know your thoughts. Please comment below. If you like this video, please click the like button. If you like my channel in general, please subscribe, and I'll see you very soon on the next video. Thank you very much, and bye for today.